Hey everyone, today is November 6, 2022, Sunday night. Market just opened up and just getting our trading plan together for next week. So that usually starts with some technical, let's look at some technicals. So for the week, we ended last week down. And so we're going to just make a little mark there that, this was the end of the week. And it was a down week. All right. So we'll just make a note of that and go down to our daily. So you can see, market is really coming off of the lows here at 3502. And rallied up over several weeks, about 12% from the low, and still in a sell-off mode. We had a day up, an up day on the 4th, but I'm going to show you where most likely this is going to continue down. So let's go to our 4-hour chart. And, we like to look at these where volume is happening, and what range the volumes define. So this was our last big volume bar right here. Friday, it put in a high volume range between 3725 and 3808. So that's kind of where the market is now, in this range. So let's look at, say, a 30-minute chart. And we're zeroing in, like as if you're from a 50,000 foot square view coming on down, right? So Friday, market rallied up above the previous day high, then sold off, then rallied up again, all in Friday in the afternoon. This was the last closing candle, and now it looks like the market is moving down to make lower lows. So this range is being respected as resistance. My anticipation would be that there's not going to be enough volume to continue this lower, and it's just going to hang around in this, it'll hang around in this 50% level until, volume in the morning starts coming in, and then maybe a little rally and another low. That's, and no one knows exactly what it's going to do. No one ever knows, but most of the time these ranges make extensions, like 50%, 100% extensions, most of the time. And I have some data that I can share with you guys to prove that it's like happening very frequently. So that's that for technical analysis. Market is making new lows. We're expecting a new low. We're anticipating a new low. So if you're a swing trader, you're in and here, stop above this range, or you might even want to go up to R1 or R2. We have to wait to see what the market looks like tomorrow morning. Sometimes overnight can be surprising based on, what happens in the Asian session. It could blow through this range. So I don't like to get in until like 7, 8 a.m. So at least those overnight sessions are over with, and we're moving into New York session. Now that's swing trading. Option trading, this is where we are. All right, so we're going down, right? We're moving down. Weekly is telling us that. Daily is telling us that. And we're expecting lower lows. So, what I'd like to do is think about selling a call. This is what I'm thinking about doing. Starting the week off like this. Selling a call And so I'm going to the 39 days to expiration and going out to the 30 delta or so. I think that's where we started this. All right. Now, this is where it gets a little interesting. So, instead of just selling a call, I'm going to buy a call against that. Okay. I'm going to buy 6 and I have 11 here. All right. I have 11 call spreads against 6 call debit spreads. Now what that does is it protects my downside as opposed to just, putting on a, regular, it protects my upside, not my downside. Protects my upside because the call spread, see how it narrows that range and it lifts this 10 up a lot. So this is our starting, I'm thinking about starting like this. I might even go a little more narrow like that, okay? 7 calls to bought to 11 sold, all right? And the max depth risk here is 1,800. And we're basically, by doing that, the market goes down, we're locking in a 130 credit on this whole thing if the market continues down. Now you might be saying, oh, that's not really an interesting profit, right? But these kind of spreads, they have another purpose to them, and I'll show you that here. Let's look at this opening Greeks. Okay, you see we're short 2 delta, 10 theta, and Vega is 3 to 1, right? So, and here we are November 6th. Now, if the market stays the same, we're good. Theta's coming in. If the market goes down, we're good. We don't make a move. We just wait for that. We wait for that market to give us our maximum theta decay if it keeps going down, which we're anticipating. That's why we're starting like this, okay? If the market starts going up, let's say the market goes up 20 points tomorrow. Now look at the theta delta. Okay, that's 20%. Now we like to keep those ratios in line. There's a couple of ways to do that. And one way to keep it in line would be to sell. Now, if the market goes up, right, would be to sell a put spread. Bingo. All right, now what did that do to our delta? You see how that brought that delta down to 0 and neutralized our delta, enhanced our theta, but now we got way more Vega than theta, right? We got almost a 5 to 1 theta Vega ratio. So what would you do at that point to, you're now the market's rallying up, you've sold puts to neutralize delta, right? See, before market's going down. And remember, if the market ramps back down, we still got this original position on, which is great. That's not going away. We're just modifying it as the market rallies up. So if the market rallies up and we need to neutralize delta, we sell some puts. Boom. Now we're in this weird iron condor kind of position. The problem we have here, everything's looking beautiful. Theta's coming in, but the problem we have is the Vega to theta ratio. Vega to theta ratio is kind of is a little bit out of whack. So what you can do to knock that down is to put on a call calendar spread. Sorry, it's right here. And notice where I'm same expiration. I'm buying, selling same expiration, buying 2 weeks out. All right. Okay, and that is centered a little downstream. It's not centered right here. It's centered at 36.50. And that really extends, does a few things. It extends my range. It keeps things delta negative. And most importantly, it brings my Vega to theta ratio to 1:1. All right, 1:1. I don't really care if it's negative or positive. I just want that 1:1, that math to be right. You know, you don't want Vega, a change in the VIX, to wipe out your whole position in no time, like Muhammad Ali. I mean, it can happen, right? So this is a really interesting hybrid, option hybrid. You got almost 150 points to your downside break even. You have almost 200 points to your upside break even. And we're only planning to be in this. If we put this on tomorrow, we'd only plan on being in this for 7 days. Okay. 7 days out, our return here is great. 2,000 is the max, 3,000 is the max loss, and you're making $500 on that. So that's a really good, 15-18% return on risk. And the thing that makes it really great is it's a smoother ride